Today, we will take a closer look at Amazon, the world's leading e-commerce platform and a global leader in cloud computing and digital infrastructure. In the fourth quarter of fiscal year 2025, Amazon generated $213.4 billion in revenue, up 14% year-over-year, supported by solid holiday demand and continued growth across AWS and advertising. Online stores remained the largest contributor, while third-party seller services and advertising continued to expand within Amazon's marketplace ecosystem. AWS maintained strong momentum, driven by sustained demand for cloud and AI-related workloads. Amazon delivered $103.4 billion in gross profit, representing a 48% gross margin. Operating income reached $25 billion and was evenly split between AWS and the rest of the business. In effect, AWS produced about half of total operating profit, despite accounting for a much smaller share of revenue, making it the key engine behind Amazon's profitability. Net income totaled $21.2 billion, equivalent to a 10% net margin. Earnings per share came in at $1.95, slightly below market expectations, despite stable margins and continued operating leverage. Looking at the trend from 2021 to 2025, Amazon's fourth quarter revenue increased from $137.4 billion to $213.4 billion, up more than 55% over 4 years, underscoring sustained long-term expansion and increasingly pronounced year-end seasonality. Online stores remain the largest revenue pillar at $83 billion in Q4 FY25, though growth has moderated to a mid-single-digit pace as the core retail business matures. Third-party seller services reached $52.8 billion with a 14.9% CAGR, supported by expanding seller participation and higher monetization of fulfillment and marketplace services. Advertising climbed to $21.3 billion and grew fastest at a 21.7% CAGR, driven by strong purchase intent data and ad placements positioned close to the point of transaction. Subscription services generated $13.1 billion and maintained steady double-digit growth, reflecting continued Prime membership expansion and recurring digital revenue streams. AWS followed with $35.6 billion in revenue and an 18.9% CAGR, outpacing overall company growth as enterprises scale cloud infrastructure and AI workloads. Physical stores and other segments remain smaller contributors, growing at a more moderate, mid-single-digit pace. Overall, Amazon's growth mix is gradually shifting toward higher margin, more scalable service businesses. Over the past decade, e-commerce has steadily taken share from traditional retail. The online portion of total U.S. retail sales increased from 8.7% in 2017 to 18% in 2025 and is projected to exceed 23% by 2030. In other words, nearly 1 out of every 4 retail dollars in the U.S. is expected to be spent online within the next few years. At the same time, the size of the U.S. e-commerce market has expanded significantly, growing from roughly $429 billion in 2017 to over $1.3 trillion in 2025, with further growth ahead. This reflects a structural shift in consumer behavior rather than a short-term trend. Within this expanding market, Amazon has maintained a dominant position, consistently controlling around 37 to 38% of U.S. online retail sales in recent years. Despite rising competition, Amazon remains the largest beneficiary of the ongoing shift toward digital commerce. From 2021 to 2025, the share of units sold by third-party sellers increased from around 55% to just over 61%, meaning that nearly 2/3 of all items sold on Amazon are now handled by independent merchants rather than Amazon itself. This underscores Amazon's continued shift away from inventory-heavy first-party retail toward a more asset-light marketplace model. In Q4 2025, the third-party seller share declined slightly from 62% in Q3 to 61%, largely reflecting seasonal strength in Amazon's own hardware sales, including Kindle, Echo, and Fire TV during the holiday quarter. On a year-over-year basis, the figure remained broadly stable compared to Q4 2024. Even with this fluctuation, third-party sellers remain structurally central to Amazon's marketplace. In 2025, Amazon's retail business is entering a new phase, shifting from a period of cost discipline toward renewed investment in AI, logistics, and ecosystem control. At the center of this strategy remains the core online marketplace, which generated $83 billion in Q4 2025 and continues to be supported by everyday essentials, now accounting for roughly 1/3 of U.S. units sold. Faster delivery has become a key differentiator, with more than 8 billion same-day and next-day units delivered to Prime members, enabled by the regionalization of Amazon's U.S. logistics network into 10 zones. At the same time, Amazon is defending its value proposition against ultra-low-cost competitors through initiatives like Amazon Haul, a sub-$20 direct from China model that prioritizes price over speed. AI is increasingly embedded across the shopping experience, with Rufus surpassing 300 million uses in 2025 and materially improving conversion rates, while visual shopping through Amazon Lens continues to gain traction. Physical retail is being streamlined around Whole Foods, including smaller daily shop formats that double as local fulfillment hubs for faster grocery delivery. Behind the scenes, third-party sellers remain structurally central to the ecosystem, accounting for 61% of global units sold in Q4 2025. Amazon is deepening this relationship by expanding supply chain by Amazon and introducing new FBA fee structures, tightening its control over end-to-end logistics. Taken together, these elements show how Amazon retail in 2025 is evolving into a more integrated, AI-driven, and logistics-led ecosystem designed to defend scale while reinforcing long-term competitive advantages. By 2026, the global digital advertising market is projected to reach around $869 billion, continuing its steady expansion. Within this landscape, Amazon has firmly established itself as the third-largest digital advertising platform globally, a position it has maintained for several consecutive years, behind only Alphabet and Meta. What differentiates Amazon is that over 80% of its advertising revenue comes from U.S. retail media, tying its ad growth directly to shopping behavior and transaction data rather than pure brand impressions. In the U.S., retail media is expected to account for about 21% of total digital ad spend in 2026. Within this segment, Amazon remains overwhelmingly dominant, controlling approximately 77% of U.S. retail media ad spend, far ahead of Walmart at around 7%, with the remainder fragmented across other retailers. This sustained leadership helps explain why advertising has become one of Amazon's most durable and high-margin growth engines.
By 2025, Amazon Prime has evolved into a powerful global flywheel, reaching 250 million members worldwide, including nearly 80% of U.S. households. Today, roughly 3 out of 4 Amazon shoppers are Prime members, showing how deeply embedded the program is within Amazon's core business. Beyond the U.S., India is emerging as a key growth frontier, already counting 28 million members. What keeps this scale intact is Prime's value equation. Members receive bundled services worth about $1,430 per year, while paying just $139 annually, supporting a 91% renewal rate and giving Amazon room for a planned price increase in 2026. Engagement then feeds the flywheel. Prime Video continues to grow through major sports rights, including Thursday Night Football and a long-term NBA deal, backed by $22.4 billion in content spending. The ad-supported tier alone generated $806 million in 2025, with about 80% of viewers accepting ads. At the same time, Audible dominates the U.S. audiobook market with over 63% share and 40,000 AI-narrated titles, while Amazon Music holds around 11% global share, adding further depth to the ecosystem. Streaming's share of total U.S. TV viewing has risen from roughly 36% in early 2024 to nearly 47 to 48% by the end of 2025, officially surpassing cable and broadcast combined. This confirms a structural shift in viewing behavior. Within this landscape, Prime Video accounts for around 4% of total US TV viewing time and continues to trend upward. Rather than competing purely on scale, Prime Video plays a strategic role within the broader Prime ecosystem, supporting engagement and retention. Live sports, led by Thursday Night Football, help accelerate viewing growth and strengthen its position in connected TV. As ad budgets continue shifting towards streaming, Prime Video's integration with Amazon's first-party commerce data positions it well within the expanding CTV advertising market. By the end of 2025, AWS had further solidified its leadership in cloud infrastructure. Quarterly revenue expanded from about $13.5 billion in early 2021 to $35.6 billion in Q4 2025, reflecting strong demand for cloud and AI workloads. At the same time, operating income rose to $12.5 billion, implying margins near 35%, reinforcing AWS as Amazon's core profit engine. A key differentiator is custom silicon. With roughly 1.4 million Trainium 2 chips deployed and a $10 billion annualized run rate from Graviton, Trainium, and Inferentia, AWS is improving price performance while reducing reliance on external GPU supply. AWS continues to lead the market with roughly 29% global share, even as that share has edged down slightly amid intensifying competition. By 2026, Amazon is entering a major infrastructure and AI pivot, with capital expenditure approaching $200 billion, accepting near-term margin and free cash flow pressure to secure long-term structural advantages. At the center is AWS. Amazon is advancing Trainium 2 and 3, targeting 30 to 40% lower AI training costs while exploring nuclear-powered data centers to secure energy at scale. At the software layer, Bedrock and Amazon Q are evolving toward an integrated AI agent platform, reinforcing AWS's vertically integrated stack. In retail, Amazon is pursuing a dual approach. Amazon Haul for sub-$20 value goods, alongside 30-minute urban delivery, and a new 225,000 square foot hybrid store in Chicago to scale speed and convenience. Prime and Media continue to drive monetization, supported by a potential move to $159 annual membership, deeper Alexa Plus integration, and expanded sports rights across the NBA, NFL, and NASCAR. Meanwhile, Amazon Leo enters commercial beta in 2026, representing a high-risk satellite expansion with significant launch costs and regulatory hurdles. Overall, 2026 reflects a strategic inflection point: short-term pressure in exchange for a broader, long-term moat across AI, energy, logistics, and connectivity.
Looking at Amazon's operating expense structure in Q4 2025, the company clearly prioritized investment in logistics and technology infrastructure. Fulfillment expenses reached $30.8 billion in the quarter and have grown at a compound annual growth rate of about 14.1% over the past several years, reflecting continued expansion of the delivery network, faster shipping speeds, and higher automation across fulfillment operations. Technology and content spending totaled $29.4 billion in Q4 2025 and has increased at an average annual rate of roughly 10.4%, driven by sustained investment in artificial intelligence, cloud infrastructure, data centers, and digital content. In contrast, more traditional operating costs have grown at a much slower pace. Selling and marketing expenses amounted to $14.3 billion in Q4 2025 and have risen at only around 2% per year, indicating that Amazon continues to rely on ecosystem scale and Prime-driven engagement rather than aggressive marketing spend. General and administrative expenses have increased at approximately 3.6% annually and remain a relatively small share of total costs, highlighting ongoing discipline in overhead even as infrastructure investment continues to scale. While revenue has increased steadily from quarter to quarter, net income has followed a much more cyclical pattern. The divergence became most visible in 2022, when Amazon reported net losses and margins fell to around -3%, as elevated logistics and fulfillment costs,
excess warehouse capacity, and valuation losses from equity investments weighed heavily on profitability. Beginning in 2023, earnings rebounded sharply as Amazon streamlined its fulfillment network, strengthened cost discipline, and benefited from improving operating leverage. By Q4 FY25, net income reached $21.2 billion, with the net profit margin at approximately 9.9%. Although slightly below the peak level seen earlier in 2025, profitability remains structurally higher than in prior years, reflecting a more balanced earnings mix increasingly supported by AWS, advertising, and subscription services. From fiscal year 2022 through fiscal year 2025, Amazon's reported revenue has consistently expanded and generally aligned with market expectations, demonstrating solid demand visibility across its core businesses, including e-commerce, AWS, cloud services, and advertising. According to consensus estimates, Amazon's full-year revenue for 2026 is projected to reach around $805.2 billion, representing continued double-digit growth and underpinned by strong cloud adoption, Prime ecosystem engagement, and expanding digital advertising. In contrast to its top-line stability, earnings per share have shown greater sensitivity to investment cycles and capital allocation decisions. Consensus estimates indicate that annual EPS is expected to rise to approximately $7.44 in fiscal year 2026 as AWS and higher-margin businesses scale, supporting improved operating leverage. The company's aggressive capital expenditure plan of around $200 billion for 2026, directed toward AI infrastructure, data centers, custom silicon, and robotics, has elicited mixed reactions from investors, reflecting near-term pressure on free cash flow even as long-term strategic positioning strengthens. Amazon's share price has edged lower in recent sessions amid broader market volatility and renewed concerns around the company's elevated capital expenditure plans for 2026. With Amazon outlining substantial investment in AI infrastructure and cloud capacity, some investors appear cautious about near-term margin and free cash flow pressure, leading to short-term weakness in the stock. Despite this pullback, investor sentiment remains strongly positive. Based on consensus from 63 analysts, the average 12-month price target is approximately $281, implying about 41% upside from the current price, near $199. The bull case stands at $360, while the bear case is around $175, suggesting a favorable risk-reward profile. Analyst ratings continue to reflect a prevailing strong buy view, underscoring broad institutional confidence in Amazon's long-term earnings outlook. Thank you for watching. The information presented in this video reflects opinions at the time of publication, is based on sources believed to be reliable, and is provided for informational purposes only. It does not constitute investment advice or a recommendation.